Thank you for listening to the Real Estate Real podcast. Here is your host, Adam Ashba.
Welcome, everybody, to this episode of Real Estate Real podcast. We have a very special guest today, a good friend, Aric French of Academy Mortgage. He is the area, is it vice president? Is that your title?
Manager, yeah.
Manager, I'm sorry, of Ohio. So Aric, tell me a little bit about yourself, and then we're going to dive into how the COVID-19 epidemic has affected the mortgage industry, as well as people getting qualified for mortgages, because I know that's a concern, and how that might change over the next few months if you buyers and agents that have buyers how their clients might be affected from this. So go ahead, Aric, and introduce yourself.
Yeah.
You might do a better job than I just did. So
I appreciate you having me on for sure.
You're welcome. Thank you.
My name is Aric French. I'm an area manager with Academy Mortgage over the state of Ohio. I've been in the mortgage industry for about 8 years now, and my branch is located downtown here in Columbus. So to be honest with you, Adam, I can't say I'm the expert here, but I've never seen anything quite like this. And I think that's kind of the theme here with everybody in our industries and consumers as well. You know, nobody's ever really seen anything exactly like this. So I really appreciate you having me on. There's a lot of moving parts to this, and we'll definitely dive into and dissect what's going on and what the best path forward is for your realtors and your consumers.
Yeah. Well, let's talk about, well, first of all, like you hear a lot on the news and things about that the mortgage industry, there's some lenders that could be on the verge of bankruptcy. Why would that be? Can you explain to
That's a great question.
The normal person, why would they be an issue? They're the
Yeah, the quote that I just heard recently a couple weeks ago was from one of the executives over at JP Morgan Chase, and he literally said, this liquidity issue that we're seeing, liquidity simply means cash, is one of the biggest issues since 2002 facing the mortgage industry. And you'll notice that 2008 would be included in that time frame.
Right.
Definitely a worse liquidity position than we would have been in 2008. To understand the liquidity issue and the issue facing the mortgage industry, we kind of have to understand first, for your listeners, how the mortgage industry works. So two things that we're going to point out. Number one, if you are a loan servicer, meaning if you service mortgage loans, you have to make the payment of that loan, the principal and interest, taxes and insurance payment, to HUD or to the VA, even if your borrower doesn't. So again, if you're servicing specifically government-backed loans, you have to make the payments of those loans to HUD or the VA, even if your borrower doesn't. So that, we'll come back to that. That's going to be issue number one. Issue number two is what's called margin calls. And in essence, because of all the volatility that's going on in the mortgage industry right now, rates you've probably seen are up and down and all around, and the government has been involved in keeping rates artificially low. The way that it works as a lender, if you're a mortgage company, bank, credit union, or lender, and you lock a consumer's loan, and rates change from the time that you lock that loan to the time that you're delivering it to the investors or the secondary markets, you have to pay the difference as a lender. So when a lender locks a loan, what they actually specifically do is they hedge their bet, and they basically take out almost like an insurance policy against rates going, rate movement in the meantime. They're going to what's called short the bond market, so that if rates go up and their loan rate is now worse than what is currently being available or currently available on the market, now because they've shorted the market, they don't have to pay the difference. They're going to have to pay the difference, but they get that income rate back because of their short position in the market. What this is called a margin call, essentially, in a lack of a better term. Specifically what happens is investors want mortgage companies to pay the difference of where rates are and where the rates that they're delivering to the investor or the loan servicing company or Fannie Mae, Freddie Mac, and Ginnie Mae. The loan company, the originating company, has to pay the difference of where that rate is and where the market rate is. So because rates have been up and down, companies are having to pay out quite a bit of money to keep all of their locked loans safe and secure. So February and March, rates got to be the lowest of all time. So us as mortgage companies, we all locked in the biggest pipelines we've ever seen, specifically to the tune of a few $1 trillion. I mean, I remember one day reading an article about a month ago that Quicken Loans had locked $2 billion in like a week, and that was their whole capacity doing loans. That was it. That's all they had. That's the amount that they were able to fund in a month. So they actually had to like turn away loan officers and stop taking applications for a few days. So rates went really low. Everybody locks in everything. This is awesome. Now rates go up. Well, lenders have to pay a margin call to the investors to secure those rates. So that's bleeding a lot of cash right there. Now we look ahead, and the government is telling all of our consumers that, well, you're going to be able to not pay your mortgage if you have COVID-19 or if you've been impacted. This is a great idea. Obviously, the forbearance is a good idea, but the execution of the idea has been very poor on our end. We've been given so little clarification as to what that actually looks like or means as a lender, which is really scary. So what we typically do as lenders is we extrapolate from the unemployment numbers the projected default rate, or those people that would foreclose on a mortgage. So we take that from the unemployment numbers, and we can project forward how many people will foreclose on a mortgage. Before all this happened, the default rate, the foreclosure rate in America was the lowest it's ever been. And the unemployment rate was also near record lows as well. Inside of a 2-week span, while we're having to pay all these margin calls and all this trauma is going on, inside of a 2-week span, the unemployment rate jumps. And as you probably have seen, it's just jumped more than it has. People are comparing it to the Great Depression. You know, we're talking about 10, 20 million people out of work, almost overnight.
Right. Literally. Yeah.
Literally. Yeah. And then you have a bunch of, people going through this forbearance process, meaning they're not going to be able to make their mortgage payments for 3, 6, 9, or 12 months. So now loan companies are having to make those payments for the borrowers in the case of government-backed mortgages, while they've had to pay out all this margin calls and bleed through a lot of cash up front. So it's kind of like the perfect storm. They have huge pipelines, they have a lot of locked loans, and now they have a lot of borrowers not making their payments all in the span of a few weeks.
Right.
It's the perfect storm for a mortgage company.
So in layman's terms, I'm going to kind of back up a little bit.
Sure.
So really the things that are causing issues from a cash flow and liquidity on the mortgage side, the first issue is the servicing. And basically, in layman's, Aric's a very intelligent guy. That's why I had him on, right? So in layman's terms, it means basically, since these borrowers are getting these forbearances from the government saying, hey, you don't have to make a loan payment for the next 3 months, 6 months, 9 months. That doesn't mean the end investor doesn't get their money. They're still getting it. Who's paying for it? And really that means the banks. So when Joe borrower says, hey, I'm not making a payment for whatever reason, but obviously it's the COVID-19 issue, that money still has to be paid. So that's the first issue. And mind you too, there's millions and millions of loans that would be under that umbrella, correct? I mean, is it every FHA, VA, USDA loan? Does that include conventional loans as well, or no? Just government?
Yeah, great question. With conventional loans, you only have to pay mortgage insurance to the loan servicers, Fannie Mae.
Okay. I didn't know.
Servicers, the loan securitization entities, Fannie Mae and Freddie Mac. With government-backed mortgages, it's the whole payment.
Jeez. Okay.
Yeah. So yes, they're servicing taxes and insurance. So it's really just the principal and interest payment of the loan. But again, you do the math on it. Yeah. Mr. Cooper, a large loan servicer, just a few days ago, I saw an article that they had 35,000 people file for forbearance, meaning they weren't able to make their mortgage payment because they were laid off because of COVID-19. I think two things from here. We need to really talk about what forbearance really truly is, because there's a lot of misinformation about it.
Okay, yeah, go ahead with that.
I'd like to go into that a little bit.
Yeah, go ahead, Aric.
But just to finish out my point here, 35,000 people are not making their mortgage payments. That's $35 million that Mr. Cooper is going to have to pay out to FHA, to VA, and that's a month.
For the month of April.
Go up.
Right. And there's going to be a tremendous amount more people that are going to apply for forbearance.
Exactly.
Right? That was just the first week, right?
Exactly.
Yeah.
That's right. That was in March.
Okay.
Yeah, that was where March numbers. So
yeah.
April's gonna look like. So that's what's creating the cash flow and the stress issues on the mortgage companies in general. But to talk about forbearance for a minute, this is really important for your consumers, for your realtors, everybody that has heard this term. There's so much misinformation. First, the definition of a forbearance is not a forgiveness. The actual definition of forbearance is that you're not going to have to make those payments in the month that they're due. They're going to push out the due date of those payments. I'm going to use an example here, a really loose example. If your payment is $1,000 a month and you can't make that payment, you do a 3-month forbearance. On the 4th month that you've gone without a payment, all 3 of those other months are now due, and the 4th month. So in that 4th month, you owe $1,000.
Really? So it's almost like a balloon.
Exactly. It is a balloon. And if you can't make that, you have options from there. And the options are, some servicers will cut that $4,000, divide it by 12, and sprinkle it across your next 12 months of payments. So $4,000 divided by 12, ballpark of $5.
Almost like property tax
is $1,500 to $1,600 a month, whereas it used to be $1,000, and that's for a whole year. And if you can't afford that, you have to foreclose. The other options in parentheses here, are what's called modifications. I'm sure you've heard this term before. This is a little bit more familiar, but there's no federal regulation exactly directing each and every servicer under the modifications of their whole servicing portfolio. So sometimes it's like you can go, make interest-only payments for a certain time. I've seen all kinds of different modifications, but these prohibit, both of these, the forbearance, the modification, they prohibit you from being able to refinance your mortgage. Can't refinance if you're going through those processes. They also look very negative if you're trying to sell your house and then buy a new one. If you've been in a modified mortgage, it could be a little bit tough to get out of that modified mortgage, and a lot of times it's a larger balance that you owe than what you think. So it's very, very scary when both of those options are very much frowned upon in our industry when it comes to doing new loans, purchase transactions, and refinance transactions. None of those are good options. If you have the means to make your payment, the best thing for you is to make your payment.
Okay. So basically, and when you talk the forbearance, that's an FHA or a VA loan specifically.
This can be conventional as well.
Or conventional.
Pretty much all loan types. Yeah.
All of them. Okay, so basically almost all the loan programs out there for all the listeners, that if you do go through the forbearance process and you do a 3-month or a 90-day, on that 4th month, it's all due.
Exactly.
Okay. All right. I did not know that. Well, because we haven't really got to that yet. So, okay. So that's a good thing. I think I was kind of under the assumption that they were just going to back end it, meaning you had 3 extra payments on your 30-year loan or something. They were like they're doing a car payment or something like that.
Yeah. I wish, that would probably be the best option, but
Right.
Not, again, going back to what I said before, we have no clear direction about this from the federal government. They're telling people they cannot make their mortgage payments, and they're not telling us how to service that. If this was a special program where you could just add it to the end of your loan, I would definitely be happy to announce that and happy to say that, but that's not the information that we've been getting, especially not from the government.
Okay.
What we have been getting is that loan servicers kind of have to figure it out for themselves. So I've seen some loan servicers take the total amount owed, divide it by 12, and do like a 12-month payback. I've seen some do a 3, 6, or 9 payback.
Okay.
And some that can't afford to do that. So they say your whole payment is due, and if you can't make it, you either have to do a modification or foreclose.
Who's making those rules? Is it the lender? The
Great
service?
question. It's supposed to be, when the government's announcing, you would think that they would also have regulation backing it. Well,
Right.
they don't have any regulation backing the forbearance process for us as servicers or lenders at all. That's the issue too. We just have been given no clear guidance on it from the government. We don't know what to expect going forward. And that fear is also causing a lot of investor pandemonium as well. If you are an investor and you're going to buy a bag of M&Ms and you have to eat the whole bag, would you buy it if 1 or 2 M&Ms were poisoned? Of course not. That's why investors are pulling out. So that right there.
It depends. Are they peanut butter or?
Right. That right there in layman's terms is why we're seeing investors backtrack, them not want to service mortgage loans, not want to, take on originating new mortgage loans of certain types, be very stringent on and raise their qualifications for mortgage lending. So one of the themes that I've seen is a lot of mortgage lenders have raised their guidelines for credit scores.
I saw that with Chase came out with something along that lines. Yeah.
Chase went to the absolute extreme. That was crazy. I was not expecting that. I've seen people raise their credit scores on lenders, raise their credit scores on FHA, VA, and USD.
Deter borrowers.
Right. Exactly. To deter borrowers and also to make sure that if they do this loan, somebody's going to be able to buy this loan and start the loan in 6 months or 9 months or whenever.
Yeah.
But, I've seen 640, I've seen 660, I've seen 680. I sent you the article, or at least I posted it on Facebook. Chase raised their guidelines for all loans to 700 FICO score requirement, and all loans have a 20% down payment requirement as well. Those are two.
Like in the 80s.
Fine. Yeah. It's exactly.
When our parents were buying and things like that. So
if you remember, there was no real securitization market, like the securitization of loans, meaning the packaging of loans and the selling them to investors on the secondary market in bonds, mortgage-backed securities. That was really just getting started.
Right.
Late 70s and early 80s. So that's why, you had such stringent requirements. So to go back all the way to there with those same requirements tells me that there's an issue with the securitization, and the issue is exactly what we've already identified. People are scared that they're not going to make their mortgage payments.
Mm-hmm. So really the next 2 or 3 months, because we started getting a little loose on underwriting, I thought and then literally overnight we went the complete opposite direction. So do you feel, Aric, that like over the next 3 or 4 months, if you're looking to buy a home, you better start checking in, because it's going to be a little tougher from an underwriting guideline. Going forward for a little while.
I think so. I've seen a lot of misinformation on this too.
Okay.
People are saying you can't buy a home right now, and that's not what I'm here to tell you. And the good news is there are still programs that you can qualify for, and that can be used to help you purchase a home. We're still seeing down payment assistance programs being offered through the state of Ohio and through other state entities as well. We are conventional loans down to 3% down payment are still available. And the key here is that FHA has not changed their guidelines. Lenders and investors are the ones who have changed their guidelines to combat the risk that is facing the industry and these cash flow issues that are facing the industry. FHA, if you're putting down more than 10% on a mortgage, they still have a guideline that says that you can buy with down to 500 credit score. It is your lender that is telling you, hey, you can't do that right now. Same thing with your 580 credit score range. FHA says if you're putting down 3.5% on a mortgage, which is their minimum down payment, you can still go down to 580. However, lenders and investors have raised their guidelines. So I have seen companies still at those low guidelines.
Okay.
They're typically companies that service their own mortgages, that don't care about, investors in the secondary market. Our company, Academy Mortgage, we are servicing 100% of the loans that we originate, so we can go to guidelines directly. However, it's just a very turbulent and interesting time. That's to say it lightly.
So basically, if a borrower, let's use Chase for example. So if they're going through the pre-approval process with Chase, and Chase says, "Oh, sorry, we've changed our guidelines." Since FHA haven't changed their guidelines, and that's kind of the ultimate deciding factor. They really should be checking with other lenders to see,
Exactly.
hey, if Chase doesn't service me, I need to check around, because I know as long as FHA doesn't change their guidelines, someone should take this, as long as they're within the FHA guidelines.
Exactly. The only guidelines that have actually changed in our industry are actually for the better. The guidelines that have loosened recently are for appraisals. Because of COVID-19, VA, FHA, and conventional appraisals can now be exterior only. The appraiser doesn't need to actually go to your seller's house.
Interesting.
Because of, the spread. So they're going to lean on your listing agents and the photos of the property to determine the value, which is interesting. It's a good change, though, for the time being. It's a safety precaution ultimately. And aside from that, the only other change is that we have to re-verify employment. It's not really a change. It's just a memo kind of pushing this again, that we have to re-verify employment very close to closing, so that we can ensure that your borrower has not been furloughed or laid off or listed as unemployed right before closing. We do have to make sure that borrowers are still employed. I've seen lenders, even with this guideline, sort of say, hey, it's okay if you have a date where you're supposed to go back to work and you can, you for sure know what date that is, we can still do the loan. I've seen it both ways, but, we are supposed to not be doing loans at all, which makes sense, obviously, for those that are unemployed. So as far as, is now a good time to buy, just looking at the macro for a second, we are losing loan types because of all the investor fear pandemonium. There's loan guidelines that have been more strict, down payment requirements have become more strict, things like that. Different mortgage lenders, servicers, and banks, some of the biggest. And we are also losing borrowers because if you're laid off or unemployed or furloughed, most of them take a step back and don't want to buy a house, which definitely makes sense. It's a large financial transaction. You don't want to do that when you're not receiving income or your income is unstable. So we've just lost like 50% plus of the buyer pool that was out shopping for homes. So if it's a good time to buy, once everybody goes back to work, it's going to be chaos, because everyone's going to try to buy all at once. It's going to really bottleneck us. This summer probably will be the busiest summer, I would imagine, for mortgage lending and for real estate transactions that Central Ohio has ever seen. I do think once everything opens back up, it's going to be a fast open. We do have the luxury of, when you go back to work, you can immediately go back and apply for and get a mortgage loan. Now, when investors will start loosening their guidelines back up and start going down to the credit scores that they had been historically, start being a little bit more lenient, there's really no telling. Typically, these things are a few months behind where the market is. So there is a pent-up demand that causes those things to happen. So if I had to guess, I would say most mortgage companies will be offering their regular and routine guidelines sometime in a little over 6 to 9 months out from right now. So it could be a few more months before we really see that change. It's not going to be an overnight change.
Okay. Near 2021.
Right, exactly. Yeah, close to 2021.
One question that I get from people, they'll say, hey, and I have heard of people getting a mortgage rate at 2.875 or 2.9 or under 3, which is ridiculous, right?
Yep.
And that'll never happen. Well, I hope not. Something's wrong. But then and we spoke a week or two ago about, really we had a swing from low 3s up to 5 within a 2-day period. And a lot of people are like, why is that? That seems crazy to me. I didn't think it fluctuated that much. Can you explain a little bit to why that was happening? And is that still going on? I haven't checked rates the last couple of days. Is that still happening every day?
Yeah, a lot of the volatility. I mean, there is more volatility now than I've seen since being in the industry. And, your normal markets, right? Rates move maybe an eighth or a quarter of a point, and it can take a week or two for that move, and that's a pretty big deal. We did see rates move multiple points in the span of a few hours, a couple different times. So it is pretty crazy. As far as the causation behind that, it has a cumulative effect of the liquidity and cash flow issues that we've talked about, but also the capacity issues too. If you're a lender and you are, not taking on applications because you have exceeded the amount of loans that you can fund, simply put, you're going to raise rates to dissuade people from moving forward with you right there.
Okay.
I have seen some lenders run into capacity issues that have caused some of these swings. I've seen lenders run into cash flow issues that has caused some of these swings, and again a combination of the two.
Okay, so really lenders are saying, hey, we had this huge refinance push, and to discourage people from buying our product, we're just going to raise the rates so people won't even want to inquire or apply.
Yeah, it's a great way of getting people to stop the application process, immediately, right? One other, I guess we'll leave it at that for now, but that's pretty much what's causing that. Now, I will say going forward, so when the government purchases mortgage-backed securities and U.S. Treasuries, that does help interest rates. They were buying so much of these that rates were going so low while all these cash flow issues were happening. So it was kind of crazy there for a few weeks. But because of what they have done, it is likely that rates will stay low for the foreseeable future. Anytime we have an economic recession like the one that we're in right now, the government typically wants to keep interest rates low to help ease the blow, and to help the economy bounce back in the future. So it's likely that, based on governmental policy in the past, it's very likely that rates will stay low and for the foreseeable future. That's again why I say this summer will be a crazy time to purchase. If you can purchase, you're going to purchase with a very low and competitive rate, and you're not going to have, hopefully, as much competition than we've seen because of the programs, guidelines changing and things like that.
Right. Okay. Yeah. And in Central Ohio, we actually we're up 13% from year over year on home sales for February. So I'm really interested to see how we're going to trend in March and April and May and June. So I'm really interested in seeing that. So we were really at 11% year to date, had a schedule at the end of February, which kind of showed was going to be a pretty solid spring, right? It was really shaped up to be that way, but obviously things are completely changed. So I'm kind of anxious to see the stats.
Yeah, there's definitely still a huge pool of buyers out there, and it's a great time to take advantage of selling high. So if you're going to sell your home, you want to sell it when you can get the best price,
right?
Which I think is, now, and I can see that continuing on through the summer.
Yeah.
It's also a great time to buy low, because your rate is going to be so low that the relative cost, or the net effective cost of your house, is lower than it's ever been. Your interest rate being low simply means that you're spending less money on the house that you're purchasing. So if the price of that house is $100,000 more expensive, but your rate is, a significant amount less than normal rates, I mean, what's the difference in the cost out of your pocket? It's very minimal.
Right. Yep, absolutely. So what Aric's saying is give him a call. They'd be happy to hook you up and buy a house. If you can find a realtor to show houses right now. So
right, exactly.
Yeah, we're still yeah, right. Yeah, I mean, we have agents at the brokerage that are still business as usual. Yeah, so but great. Well, thanks so much, Aric. How do they if someone has more mortgage questions for you, how do they touch base with you? And I'll put all that information in the comments as well.
Yeah, most definitely. If you could just put my direct office line in the comment section, as well as my team email. My phone number, we are on call 9 a.m. to 9 p.m. 7 days a week, so you guys can literally call us anytime. We're happy to do consultations and talk about the potential of refinancing while rates are low, or purchasing without pulling your credit as well. So just give us a call anytime.
Awesome. All right. Well, thanks again, Aric. And I appreciate you staying with us and give us some good feedback here. So thanks again.
Thanks for having me.
You're welcome. Again, this is Adam Ashba with the Real Estate Real podcast. Thanks for tuning in this episode, and we'll see you next time. Thank you so much for listening to this episode of Real Estate Real. Check us out on all the major podcast platforms, Stitcher, Spotify, Apple Podcast. Like us on our fan page on Facebook at Real Estate Real, and let everyone know that this is the best podcast in America.